if we are, let's assume for a moment that you were expecting price to go down to that 4103 level, okay? And you saw this setup up here. You saw price trade up into this fair value gap. Let me move it away so you can see it. This candle's low, this candle's high, and this candle passes through between the previous candle's low and the next candle's high. There's no overlap of this candle up inside that range until we get to here. So that little shade area that I put on my charts that my students do now too, that little area is where, if you were looking at a paint roller, and the paint roller applies paint to the wall, rolls down. This little area is like a pocket of where the paint wasn't really thick. It wasn't evenly distributed to the wall, and the wall would be like this chart canvas. Okay, if there was no charts on this at all, it would be a blank canvas, like a wall before the painter puts the roller and delivers the paint on the wall. Well, as it drops down like this, from here to here, this is where, like when you take that roller, if you ever painted anything or watch a painter use a roller, when they first apply that roller to the wall, the paint is really thick. It's ample. It's delivered abundantly to the wall. And as that roller continuously rolls in the direction it starts rolling in when you first apply it to the wall, eventually there'll be small little porous little pockets where paint did not distribute to the wall. So the surface of the wall will have what? Little spots. And that is much like what we're seeing here, where the paint comes in, it applies to the wall, keep going down. But now if you look back, there's a small little area here where, in an ideal world, the painter would take that roller, apply more paint to it, and then do what? Roll back up over top this little area and this little area. And then he can move on to another area of the wall where he hasn't painted yet. Does that make sense? To me, that makes sense as an analogy, because if that would have been taught to me when I first learned how to read price action, it would have made a whole lot more sense versus overbought, oversold, what swing high is the real one with divergence, and what trend line do I use? What's my moving average settings? What RSI settings should I have my set on? What do I use? MACD, a histogram, or do I use the moving crossovers? All the stuff that was a waste of my time. These are the things that would have been more beneficial to me, which is the nuts and bolts of price action. So looking at where the market can go back in and do what? Replenish paint to the canvas. Put more paint back in an area where it needs it. So when you look at price action and you identify these little areas like this, you think it's going down here. See, the painter needs to paint down to this level here. To finish the job, the price run, the algorithm will want to go down there. But it has to do what? It has to deliver the market efficiently. Otherwise, it's a straight line like CPI. When that market data comes out, what happens? The market's just doing nothing until CPI number. All of a sudden, you have a vertical line. That's it. That's it. It's all you have is a vertical line that keeps expanding. You can't trade that. You can't do anything with it except for regret that you were in the trade. It's not going to respect your stop loss. It's going to laugh at you. It's going to literally make you feel like you're a fool and you should have never done that. And you should feel that way because the CPI is an absolute freight train. Like you're literally trying to play chicken with a freight train. It's coming right at you. Hit me. It will stand on those tracks. It will do that and drag you for miles, okay, until your account's gone or you lose your sanity. So you have to know where price is going to go. Much like the painter, when he looks at that wall, wherever he's going to start with, whether it be the left side of the wall, the uppermost part of the wall, or the lower part of the wall, wherever he starts, okay, that's the point of inception. When he puts that paint on the wall, now his job's begun. Now he has to paint the entire surface. Just watch anybody. Just go on YouTube, say painter using a paint roller, and you'll see exactly what I'm talking about in an analogy where, let's assume for a moment you're starting on a wall in the lower right hand corner. and you apply the paint. You put on the wall, maybe at the top end. You start there instead of the bottom. Top end, you apply the roller and you drag it down over the wall. The first 12 to 18, 20 inches of the surface of the wall has a beautiful delivery of paint. It's thick. There's no pockets. There's no porous little parts they got to go back and roll back over top of immediately. You just roll until what? You feel like you're not getting any paint coming out anymore. So what does the painter do? He rolls right back over that same pathway to gather excessive amounts of paint that's not necessary to be in that same area. So it's going to collect more paint, evenly distribute any areas that have these little pockets where paint hasn't been distributed. So it reapplies in old areas. Yes. What does that mean? In this area here, paint was, or price was offered both directions. So from this candle's high and this candle's low, the next candle opens up here. It trades back down and runs over top of what this candle's low was. And then it rallies all the way back up to this point. So it leaves what? It leaves this little area as a hole or a pocket where price did not go back over, where it went down in between this candle's low and this candle's high. This is inefficient. This right here is an inefficiency in price delivery. Price operates on a price continuum. Okay, and it's a efficiency continuum, meaning that the market has to continuously offer fair value. And fair value is evolving all the time throughout the day. And every time it creates an inefficiency like this, it will seek that and go back up into it. Now, it will over deliver just like a paint roller will. The painter will roll back over areas where it's already had paint delivered to the wall, right? You've seen that. There's no way to do what? You can't just paint one little pathway on your wall and then come over to the left a little bit and come back down and not overlap. You want to overlap. And that's exactly what's occurring in price action, because look at the range in between here. This candle's high and this candle's low. The market has traded down and it also traded up here. So in this little area here, on a micro scale, this is a small little balanced price range. When the bodies of these candles came back up into this fair value gap, identified with this little area right there in price, that little segment right there, look where the bodies go. See where it stops? The closing price on this candle is 4116.75. What's the low of this candle? 4116.75. That's perfect. That's a signature that shows you the market's algorithmic time. But the things I'm doing are very specific, like knowing a very specific level. This candle's low, 4116.75, happens to agree with the closing price on that candle. What's the next candle's body? It's the open, and it's the same thing. The open price is 4116.75. Now, just like that paint roller, when it delivers over top of old areas where it has delivered paint, watch the painter, they overlap over it. Why do they do that? It makes sure there's no seams. It buttons up everything. It completely smooths out and feathers the edge of an old run on paint being delivered to the wall, and then you apply it back over top of it just a little bit. Kind of like when you cut the grass, the lawn, you cut the grass and you come back over, and you're not trying to line up where the edge of the last pass with the mower was. You're going to overlap it a little bit. Why? Because you don't want to waste your time going back there again, right? Well, that's why the algorithm is coded this way. It wants to efficiently go back and reprice. So you'll see these little areas here, which I'm going to borrow this now. This area here is where this candle's low. Let me take it away a little bit further and you can see the difference. So this candle's low. Right here, this candle's low and this candle's high. High and low. It's passed back and forth between that shaded area, both directions. So when we have this pass back up into the actual fair value gap, that low to that high with this one single candle here, my eye is trained to look for that in price. I'm teaching my students to look for that too. You're going to try to enter in that. Where? Going short at that candle's high or the midpoint in between. You can, if you really want to try to be a precise, fanatic, you can try to get the fill at the high end. But many times I've tried to do that and it doesn't go there. It leaves a small little portion open. In this case, what I'm illustrating here is the efficiency of the algorithm coming back into an area that's already balanced, but it's covering up and overlapping an area where it's already traded to, which is why you're getting this and this. That's not an error. It's not a deficiency on precision either. It's just making sure there's no seams. Everything's been offered efficiently, but the bodies tell you the real story. This is where the damage is done, the wicks. But the real narrative and what price is doing is you have to study the bodies. That's where the real storyline is. And you can see how it comes right up into there and stops. This part of these wicks, okay, you have to accept the fact that your trades are going to have that much drawdown. If you're entering in here in consequent encroachment, okay, in this range here, we have what? It's balanced. It's done both passes. This candle went down to this low. And then this candle opened here and then went up this much. So I'm not worrying about all this here. I'm saying the difference between this candle's low and this candle's high, those two ranges present a range of price action that has, in this interval of, what is it, 4 minutes? Each candle's 2 minutes. In 4 minutes, price has gone back and forth in there. And you're going to hear other people say these lower time frame charts are noise. They're not noise. It's telling you what price is doing. Whether you're looking at this chart time frame or if you're looking at an hourly chart or a daily chart. If you're staring at a daily chart, is the daily chart, if you watch it from the time that the market's open at 9:30 to 5 o'clock when it closes for our hour session of dead time, if you simply watch price on that daily candlestick versus us watching it on the lower time frame, is price doing anything different? It's doing the same thing. It's this, you're doing the same thing, but we're using the benefit of a time-based chart. And you're going to get goobers out there that are going to tell you time-based charts don't work. Time-based charts don't work if you trade retail logic. That is true, but I don't trade retail logic. We don't trade retail logic. I'm teaching you how to use time-based theory to identify what the market algorithm, okay? There's only one algorithm. That's the price engine that delivers this. You're never going to convince anyone, especially in this community, that these things here are being met because buyers and sellers that use retail logic all come together and through sheer coincidence, it just happens to be perfect. Come on, it's no. I don't even want to entertain that anymore. When I see people comment and say that stuff, I immediately mute them. I'll never see another comment from that person again. You're not being blocked from my Twitter feed, but I just don't want to hear from you because you're literally closing your eyes, putting fingers in your ears. No, you don't want to hear it. Okay, I don't want to see your nonsense because to me, all it's going to do is trigger me. I can't stand seeing people deny the evidence laid in front of them. It's right in front of them over and over and over again, but they won't appreciate it because it flies in the face of whatever they believe is the real things. And the things that they're holding on to probably isn't even this precise, which to me is madness. But I'm becoming a little too dogmatic here. Let me dial it back. So we have this overlapping into this area. What is this entire range? From this low to this high right there. Watch this. There's our fair value gap. Now, if you know that the algorithm is going to do the same thing you're going to do when you cut your lawn in the springtime when the grass is growing, you're going to go out there with your mower, or the guy that you're going to hire to cut your grass for you like I do, because I ain't cutting shit. The overlapping of that mower, where you just pass through, cutting the grass down, the first pass, then you're going to turn the mower around, or they're going to turn the mower around, and they're going to lay their wheel over top of what was already cut. So that way there's no seam, right? So when you make a new pass, you're always cutting through, and not leaving that little segment of grass where you got to go, oh, I left a mohawk. You got to go back in here. My sons, the few times I've asked them to do the lawn, they hate it because they know my obsessive compulsiveness is going to force me to go to the window and see what they're doing. And I'm waiting for them to leave a little mohawk in the grass. And as soon as I see it, I'm out there. Hey, hey, go back and get that. And they flip out because they thought they were going to get away with it. But you can see it. You can see it in the grass. You don't want to leave that. So that's what these little things are here, preventing any little mohawks in the lawn. I know I'm giving you all kinds of analogies, but this stuff makes sense to me. If it doesn't make sense to you, then I'm sorry. But if you look at that balanced price range between this candle's low and this candle's high, the range between this low and that high, if we measure that and you get a midpoint level, that is mean threshold. Why? Because we're measuring candlesticks that have bodies. If it were a gap like this fair value gap, the midpoint is consequent encroachment. Consequent encroachment is what is permissible within a range. So over here, we have 4,117.50. It just so happens randomly, with buying and selling pressure being as it is, completely random, how far can it overshoot this fair value gap? Well, what's the midpoint between this candle's low and this candle's high for that balanced price range? 4,117.50. What's the high on this candle right there? 4,117.50. Whoops. So it nails that level perfectly. Then it moves lower and it leaves this area here. One more time, it trades to it, above it. One more time, making sure there's no mohawks in the lawn. It's seamless. And then it breaks lower. One more time, it trades up. What is it going back up into? Consequent encroachment of this gap, midpoint. Hits it. When you see that, as soon as you see that, you're thinking, okay, this is the last time it's going to do it. Why? Because this has already went up to the midpoint of this area here. And why? Because your targets, your terminus, the levels that you're expecting and looking for, that's where it's going to draw to. Just like when you're sitting down to figure out when you're going to cut the lawn, when you start making that mower pass over top your lawn, you know you got to keep doing it until you get to the end of the lawn. Well, the end of the lawn is down here, so you got to keep constantly doing what? Apply the paint to the wall or keep pushing that mower until it goes to completion. The completion is time and price. So we're in that last hour of trading, 3 o'clock hour. The market's delivering into our objectives. But when it goes up into this level here, you're anticipating it to do what? Never go back up here. It has no need to do that. But what can it do? What's permissible? It can go back inside this fair value gap. Because why? This is an old inefficiency in price. Whereas this, the difference between this candle's low and this candle's high here, this is efficient. What makes it efficient? It's traded both directions in between this candle's low and this candle's high. So price is effectively permitting balance in order flow and price delivery. Price delivery is every time there's a new price tick and there's a new fluctuation in price action, that's delivery. That's the market being presented a new valuation on an asset. So what we're doing is we're measuring how often that delivery of price, how many times within a range specific to time, which is these two specific candles here, how many times has it passed through the same range of a specific number of prices, meaning that this candle's high here comes in at 41.18 and a quarter, 0.25. And this candle's low here comes in at 41.16.75. So between those two price points, price went down, and then this candle here opened, went up, and then went down again. So this entire range between candle high and candle low is balanced. It can go back up into the midpoint of that. That's normal. I allow for that. In my analysis, when I'm reading price, I allow for it to go up to halfway. It's rare that it will go all the way back up to the top of a balanced price range. It can. It just means that I'm probably getting ready to bail on the trade if I'm using that as a point of interest to measure if these PD arrays are able to stave off an advance or a retracement against my trade. So I'm treating these PD arrays like you are being taught to use support and resistance, but never get them to work right. Whereas the algorithm is going to go into these specific little signatures and price action that cannot be hidden from you. It can't hide it from you, folks. That should be exciting. It's not like they're going to be able to go out there tomorrow and turn off candlesticks. We all, look, are you going to stop using a clock? Raise your hand in the audience right now if you're going to say, the hell with this. I'm not using a clock. I'm getting rid of my watches. I'm never going to look at the time anymore. That's absurd. And that's the first primary function of what price does. It follows time. It does things at specific times. Then it delivers price based on the efficiency and the price delivery continuum. It has to continuously offer fair value. If the market runs too quick one direction and it goes down like it does here in this one candle, is it fair? And it's probably not the best term of using for describing this, but for the sake of making it easy to understand, because fairness is not really the goal here for these markets. But if the market drops down like this and leaves this little separation between this candle's low and this candle's high, there was no overlap, no other candle after this candle closes, no other candle printed within the price range between this candle's high and that candle's low, in between these three candles. It's that small little segment of price action creates that little pocket, the little porous price action hole. It needs to be filled in. Okay, think of it like a pothole on the road. Okay, you're going down the road, hey, boom, you just blew out your front end alignment. You're going to call the state, hey, you so-and-sos, I just tore my thing up. Well, where is that? What mile marker? Let me go back. I got to drive back up to it. There's the mile marker, and then there it is. But the fair value gap can be revisited entirely. And that's what we see here. Notice that these wicks trade up into that same old inefficiency, hits it here, hits it here. All this is a reclaimed fair value gap. Reclaimed means it simply went back to it and treating it as you would expect a resistance level to be respecting. If it's going to go lower, it's going to do what? It's going to go up, fail, go up, reject it, and send it lower. Wonderful. Wonderful. That's exactly what you want to see. You want to see that. You should not be freaking out when the market's rallying up back to these areas here, because we have this behind it, this balanced price range. This is kind of like the defender. Okay, it's the linebacker of price action. It's saying you can only go so far, Jack. You're not getting through me. It's the iron wall. Okay, you're saying no, can't get through me.